Okay, guys, welcome back to Basics, episode 20, where we're going to wrap up our fundamental analysis here. Again, if you're new here, we have a whole playlist on the series. I'm taking my fiance Jessica and teaching her how to trade. We're on episode 20, so there's a lot back there you should go through if you haven't yet, and then let us know when you're here. And then follow both of us here. So if you're seeing this on my channel, go check out Jessica. We're both on Twitter. You won't see anything but trading and dogs. I think is mostly probably 50-50 with our puppy and actual chart stuff. So go check us out there. Last part of fundamental analysis, we went through why we don't use it to formulate a trading plan, but why we use it to help protect us against possible negative things that could happen. And then in the last one, we kind of talked about what exactly we look at and why. And this one's going to be kind of more about some of the things that you have to watch out for that I just kind of have to explain to you. It's the only way I can think of saying it. It's not really you just have to know that these things exist in the market and what they're going to do to stock prices. So this is corporate actions, they call them. So when a company does something internal to the company, it's going to affect the stock price in different ways. So these are just kind of the basics of them. We're going to go over the ones that are kind of important to you. So dividends. A dividend is essentially a company paying back its shareholders. So say you own a company and that company makes net at the end of the year $1 million, right? But you don't own the company because you've sold the shares off. You're the CEO of the company. There's two things you can really do with that $1 million. One is you can give it to the owners, and that's what a dividend is. You basically say everyone who owns a share we take the $1 million, we divide it by the amount of shares that are outstanding, and everyone gets a little bit, right? The other thing is you can take that company or that money and you can reinvest it back into the company. So Apple's a perfect example because Apple spent all of its life, except maybe 5 years ago, I think, reinvesting that money. They didn't pay anything back to shareholders. Same with Amazon. They reinvest that money where they say, we will make you as an investor more money if we can take that money and put it back into the company as opposed to paying you that money.
Are you forced to agree to that?
Yeah, well, you do whatever the CEO says.
Okay.
Right? But again, remember, the whole corporate structure is the shareholder votes in the board of directors and the board of directors votes in the CEO. So if he's doing something wrong, there's ways to eliminate a CEO. But what the CEO has to do is sit down there. So Apple, way back in the early days when they invented the iPod, basically said, okay, we made $100 million this year. If we take that $100 million and we put it back into Apple and we have it invest in, better technology, the iPhone, for example, right? They took the money they made from the iPod and everything and they put it back into research and development, and then they made the iPhone. And the iPhone's the thing that really took Apple off. Now, 5-10 years down the road, Apple owns like the cell phone space. They're big in the computer space. There's really they don't really have to reinvest all of the money because they've got enough of an R&D budget that they think that they're good. So they're saying, okay, we have all this extra money, let's pay it out to shareholders.
Okay.
So what you'll notice is companies that don't really have like innovation pipelines, like power companies and water companies, these pay out a lot of dividends. Because if you're a water company for somewhere in Delaware, you're not inventing, you don't need money for research and development to invent the next big thing. You're delivering water, and it's a pretty consistent thing. So these type of companies, fuel companies, water companies, electric companies, they pay back their dividends a lot. So there's a kind of investing you can do where it's just dividend investment. You find a whole bunch of different companies, you split your money between them, and they pay you back in dividends. So you can see here on Future Fuel, they're paying a $3 dividend. So it means for every share that you own, once a year, they're going to pay you $3.
Okay.
And that equals the dividend yield there is 24%. So it means that essentially if you hold this stock at the price it is now and they continue to pay the dividend they pay now, you'll make 24% on the year. They'll just pay you.
So if the dividend is $3 and you have 100 shares, like that's not 24%. I don't understand where that percentage is coming
It's
from.
the price, the dividend divided by the price. So it's a $12 stock.
Oh, okay.
Right? And you're paying,
right.
So if you bought 100 shares,
Right.
you would make $300, but you would have invested $1,000 to make that $300.
Got it.
And this is crazy high. It probably means the company's in trouble. And one of the first things that a company does when it's in trouble is doesn't pay its dividends.
Oh, okay.
Right? If your company's struggling and you've got that $10 million at the end of the year, you might say, okay, let's keep that and put that back into the company. So it is a bit of a game, but you just got to know that it exists. Because one thing, like a lot of people, when they hear dividends, they say, well, I'm going to buy the stock right before it pays its dividend and then sell it, right? But what happens usually, everything else being equal, if a company's about to pay a $3 dividend, it will drop $3.
Okay.
Right? Like the price will adjust based off the dividend that's about to be paid. It's just so there's no free money out there. That's a game
Makes sense.
that would have been figured out a while ago. So stock splits are next. So basically the purpose of this last bit is to show you things that are just out there in the wild so that when you see them, you know what they are. You can't really make decisions off of these. And unless you want to be a dividend investor, and then you can go out there and do that. There's people, they'll do that, and what they do is they call dividend reinvestment, where if the company pays a dividend, so you bought $1,000 worth of stock, and then you made $300 on dividends. Some people just say, just buy $300 more in that stock. So next year I'll get more money and so on and so forth. But again, if you want to get into that, we can. But again, these are just things that they exist, right? They're part of nature. So a stock split, there's a stock split and a reverse stock split. We're just going to talk kind of about the reverse stock split, but it's the same way. It's basically you're adjusting the shares of the company to change the price, but it doesn't change the value of the underlying. Say, for example, your stock is worth $1,000 and you say that's way too high for most investors to even buy one share. So what I'm going to do is I'm going to take that one share that's worth $1,000 and I'm going to make my stock worth $100, but everyone gets 10 shares.
Okay.
So you see that you, instead of having one share at $1 or one share at $1,000, you had $1,000. You have 10 shares at $100, you have $1,000.
Right.
So the amount of money didn't change. There's just more shares and they're worth less of a price.
Okay.
And so companies do that all the time. If their price gets too high, they'll bring it down. Again, I keep using Apple, but they did it a couple years ago where I think it was a 7-for-1. A Friday on a close, you had one share worth $700. On Monday, you had 7 shares worth $100.
Okay.
All it doesn't really affect anything. Now, a reverse stock split is the other way, and that's actually something that you should be watching out for because it can be a detriment, and it's the other way around. So there's a rule that your company has to be worth over $1 to be listed on the NASDAQ. If it's worth under $1, they'll kick you off their exchange, which is a bad sign. So as a company goes down and their price gets under $1, if they don't have a plan to make their company better, they'll do what's called a reverse split, where you have 1,000 shares at $1 and they'll go the other way around. They'll say, no, our stock's worth $10 now, and they'll shrink the amount of shares that are out there. The thing you have to watch out for this.
Okay, so if you had, so on Friday, let's say you had 10 shares of this company and they were worth $1,000. So on Monday you would wake up with, like, is it less shares or more shares? So less shares. So you would maybe drop down to 5 shares, but they're worth $1,000 still. Is that?
No, it has to always offset. So the amount of money you have before and after a split's the exact same. So if you have $1,000 before, and they adjust your shares, they have to adjust the price by the other side.
Okay.
Right. So again, on reverse splits, so you have 10 shares and they're worth $1.
Okay.
And the company's saying, we're about to get kicked off the NASDAQ and we don't have anything that's going to make our price worth over $1. So we're going to make our shares worth $10 and you only get one share.
Okay.
Right? Now, a company's price rising too high and having to do a reverse split just to keep it in an investable range, that's a nothing burger, right? It's nothing. It's just you're moving numbers. But
say they did that with, like, say you had a bunch of shares, say you had like 1,000 shares, let's just say, and then they made it so you only had 100 shares, like whatever the math is, how does that affect your, like, the way you would trade it? Do you know what I mean?
It doesn't affect anything.
Okay.
It's right. You have the same dollar amount before and after.
So
it doesn't change anything.
Can you trade a single stock? Like if you had one share of a company, you can trade that?
Yep.
Okay.
And they would divide that into a fractional share if they had to, or just pay you the money.
Okay.
Right? There's never a time where anyone makes or loses money on a regular stock split. And again, it's considered healthy that if you have $1,000 stock, you're just lowering the price of the stock to let in more investors.
Yeah.
Again, but the other way around, when you're about to get kicked off an exchange and you're trying to pump up the price of your stock by reducing the number of shares out there, it means you had no other option. Mm-hmm. So that can be seen as a sign of weakness, right? This company is like, oh my God, they're only doing this because they don't have a way to increase the value of their company. Because, if I'm a CEO of a company and my stock's going to hit about $1, I'm going to go on the news and I'm going to say something like, look at this cool thing that we've got coming next year, or this is how, I'm going to talk about my company. But if it's still tanking and going under $1 and the only option I have is to do a reverse split as opposed to talk about how great we are or release a new product or something, that's a sign of weakness. So stock splits, don't worry about, they just happen. Reverse splits, if you see a stock and you're interested in buying it and you read they just did a reverse split, it probably means that company's hard up.
Okay.
Right? And again, doesn't mean you don't trade it. It just means in the back of your mind, this company's not doing the best. So if I'm going to trade this company, let it be a quick hit, get my money and get back out. Share offerings. So this one's a bit of a, you react to this if you see this news, if you're in a company. So I put the picture of a pump and dump. It doesn't always happen in a pump and dump, but essentially, say you have a shitty little company. And your company's been a shitty little company for a long period of time. And then all of a sudden, some kind of stars align where your $2 shitty little company spikes up to $4. And it's like you think it's almost like a temporary thing. You got picked up by the news, some big name talked about you or something. Right. Then things spike and there's a short squeeze and there's all these things. But your stock price has gone from a very low amount to a very high amount. But your company's still shitty. Your company hasn't changed over the 3 days. There's just been a massive spike. There's a lot of things that a CEO will do, but one of the first ones is sell more shares, right? So if I'm a hurting company and I don't have any money, we talked about this, that you have two options, right? Your first option is to go get debt from the bank, and your second option is to issue more shares. But people get pissed when you issue more shares because their shares are worth less.
Okay.
Right? So that they'll pick a time to do this, usually when the stock spikes.
You can do that to somebody?
Oh, yeah.
Oh, that's rude.
Well, that's where that red line is.
Okay.
But what they'll do, so if my crappy little company's worth like $1, $2, and I come into work one day and it's worth 10. Right. Now I can issue, and we need $1 million to keep our company going. I can issue way less shares at this new spiked price than I would have when it was a $1 company. When it's a $10 company, I can issue 10 times less shares than if it's a $1. But what will happen is, as soon as the share issuance starts, that's usually the end of their run, because you've kind of reminded everybody that you're a shitty company and that you need money, right?
Okay.
So if you're in a stock and that stock's spiking nicely, and then all of a sudden you see share offering, that may be one of the times that you get out. But again, remember what we talked about with news, that if you know it, everyone else already knows it. Again, the whole theme of this is these are things that happen and exist. And I just want you, when you see a headline of, oh, company did a reverse split, you know what that means. Oh, the company did a share offering, and you know what that means. And the last one's a buyout or a merger. When a company buys another company, they generally do it at a substantial premium. So this is something I grabbed from the internet. This could be February 2018, so this is an old one. But you can see the company was trading at about $5, and then it spiked up to a little bit under 10. And each of these are a candle, so you can see it just went sideways. So what will happen is Pepsi says, we're going to buy Coke, right? And Coke's trading at $50. If they want to buy the entire company, they have to go to the shareholders and offer them something. So they'll say, we'll buy it for 20% higher than the normal price is. and the shareholders will go okay, and they'll agree to it in the way they go. But what happens to the stock price is that it won't gap all the way that high. So say, for example, this buyout here on this CASC was for $12. Right, we'll buy it for $12 a share. The stock will gap up the next day to about $10, and it will slowly kind of inch its way up to $12 over the next couple months. And the reason it does that is because there's still a little bit of risk that something will happen, that the government will come and say, no, you guys can't merge, or something, they'll go through the books and they'll find that there's something bad or whatever. So the difference between what it will gap up to and the actual buyout price, that's just the little bit of risk that they're pricing in.
Okay, so let's say Pepsi did buy Coke. What happens to the people who had, let's say, Pepsi stock that was much lower?
Well, what happens to the people who own Pepsi stock is nothing, because they're the buyer. Generally speaking, what happens is this company that's getting bought out goes up, and then the company that's doing the buying goes down.
But what about in the case of a merger, not a buyout?
Same kind of thing. They look at whoever is stronger or weaker, but mergers are very rare. Buyouts are way more common.
Okay.
So you want to be in a stock that announces that it's going to get bought out, because if you were in this stock at $5 and then all of a sudden it gapped to 10 and you had 10 grand in it, you doubled your money. But the point that I want to make, and then the kind of practicality of your trading decision, is that the second that buyout's announced, there's no more trading to be had on the stock, because the stock will just grind its way up to the merger price, the buyout price, unless news comes out that the government's blocking it or something, and then it will crash dramatically. But either way, there's no trading to be had there anymore. You can't predict those things.
Oh, okay. I thought you meant like you physically couldn't trade it. But
no, you can. Okay. There's just nothing. So basically what you want to do is, if you're scanning through your stocks, and again, that's the whole theme of this, and you come across a company and it says, accepted buyout offer or something, just to skip to the next company. It's just not going to move unless there's something dramatic that happens one way or the other, right? They're not going to be trading that much at all. Now, you could go to the company that bought it and see what they did and maybe make a trade there, but the buyout company is just kind of dead in the water. And you'll eventually just spot them. Like, if you showed me this chart and didn't tell me what happening, in an eighth of a second, I'd tell you it was a buyout. And I would bet that the buyout was for $10 just because it's trading at $9.99. But again, it's always going to trade slightly below that price. And then as time goes on, it will get up to that price, and that'll be the end of it. Again, just the most important thing here, just to summarize, is dividends, just know they exist, know when they get paid. Buyouts, avoid entirely. Stock splits are fine. Be careful reverse splits, right? Just things that when you're scanning about, which is what we're going to do next time, that you make sure
there's a good volume.
Good volume, right? Short float, if that was something that was interesting to you, we can build you a whole short float scan. Things like that. But again, we don't make trades off of them, but we have to know about them because they just exist in our world. Okay, that is it.
Nice.
For this one. Again, give us a follow, like, share, tell your grandma, come watch, all of those things, and we'll see you guys next time.